Well, good morning, everyone. It is 10 a.m. on the dot, and we will call the October 12th, 2023 meeting of the Employee Retirement System to order. Item number 2 on our agenda is to approve the minutes of the meeting of September 14th, 2023. I have a motion and a second. Please record your vote. Item is approved. Item number 3 is the consent docket. We have 3 items this morning we can take with one motion. I have a motion and a second. Please record your vote. Item is approved. Item number 4 is to ratify approvals. We can approve those with one motion. I have a motion and a second. Please record your vote. Item is approved. Item number 5 is to approve the claims docket. We have a motion and a second. Please record your vote. Item is approved. Item number 6 is to approve the following applications for service retirement. I have a motion and a second. Please record your vote. Item is approved. Item number 7 is to receive report of death, approve continuation of pension to spouse. We have a motion and a second. Please record your vote. Item is approved. Item number 8 is to receive report of death, authorize payment of the $5,000 death benefit, and approve continuation of pension to spouse. We have a motion and a second. Please record your vote. Item is approved. Item number 9 is to receive report of death, authorize payment of the $5,000 death benefit, and authorize secretary to make necessary changes to conform on the following. I have a motion and a second. Please record your vote. Item is approved. Item 10 is to receive the report of death, authorize secretary to make necessary changes to conform on the following. I have a motion and a second. Please record your vote. Item is approved. Item number 11 is to approve the following applications of vested rights.
Just out of curiosity, the next item is to then terminate the vested rights. I wasn't sure on that. Do you want to
Sure.
explain that?
Sure. This participant left employment before he turned 65, and our normal process is when somebody separates from service, is we send them a packet with their options. They can begin retirement, they can defer retirement until whenever, no later than 65, or they can take a lump sum of their contributions. So this person left employment and then just decided to commence retirement once they turned 65 to avoid the early retirement penalties. Does that make sense?
So they accepted the retirement and said, wait a minute, no, I don't want to, and then the second one is?
No, they left employment and they went into a vested status,
Okay.
but they're really not commencing until their birthday. They left employment before their birthday, their 65 birthday. Does that make sense?
I think so. So I guess it's the effective date is the piece that is changing for them.
Correct.
As opposed to it being on termination.
Yes.
Now, they want it to be July 26th.
So item 11, when you see that on the agenda, that's just people going into a vested status.
Okay.
And it's just a formal thing. We could have just put that he wanted to commence his vested, but I really, because for full transparency, we normally do bring those to you and say these people are going into a vested status. I wanted to show both transactions.
Okay, thank you for the explanation.
I have a motion and a second on item 11. Please record your vote. Item is approved. Item number 12 is to approve the request of the following to terminate vested rights and commence retirement benefits. I have a motion and a second. Please record your vote. Item is approved. Okay, where are we? Item 13. You gotta scroll down there. Item number 13 is approve amendment number 1 to the Administrative Services Agreement between the City Deferred Compensation Board, the City Employee Retirement System, and the City of Oklahoma City for administration of the 457 Deferred Compensation Plan and the Money Purchase Plan and Trust 8751 and 7697 of the City of Oklahoma City.
I just
Mouthful.
want to explain to this board why we're doing amendment. As you probably some of you serve on this board, but we have another board now that governs the deferred comp, money purchase plans and 457 plans. And we went out for RFP for investment consulting services. And that board is recommending a retainer agreement with Asset Consulting Group. And in order to have the budget authority to pay them, we envisioned that would go through this agreement between the city and ERS. So there needs to be this budgetary piece of the puzzle that flows through ERS. So that was approved at the Deferred Comp Board on September 18th, and if it's approved today at ERS, it will go to council in 2 weeks. Any questions?
Hearing none, Chair will entertain a motion. I have a motion and a second. Please record your vote. Item is approved. Item 13B is our monthly investment report. Good morning, Jason.
Good morning, everyone. So you all should have the September 30 report in front of you, and then a separate piece that we'll go through where we're going to be making a recommendation on your large cap allocation. But just starting out with the economic overview at the end of September. As we've talked about all year, we've seen pretty strong returns in large cap equities across the board. If you look in the upper left here, the S&P 500, that light blue bar is year to date, and the dark blue bars that are all negative in September is the 1 month return. But you'll see the S&P 500 or large cap US stocks up 13%, on a calendar year-to-date basis through the end of September, followed by the EFI benchmark, which is international developed, up 7.1. And then if we look down below that at the Russell 2000 or small cap stocks, they're only up 2.5% compared to large cap US for the year, up 13.1. And we don't have a benchmark for non-US small cap, but it's similar. Small caps outside the US have lagged as well. Just bringing forward through yesterday, the S&P is actually up a little bit this month. And so now year to date, up 15.5%. Small cap up 1.5% on a year to date basis. And the reason why I mention this, as we look at within your portfolio, outside of large cap where we have active managers in small cap, of course, your international portfolio overall with the active managers, they tend to move down in cap a little bit more. And so relative performance has lagged a bit there. The middle of the page, you'll see our outlook is in terms of valuation. This isn't necessarily a predictor to say we need to get out of something and into something. As you know, you're a very long-term investor with long-term liabilities, so we want to maintain that strategic allocation. But I think it's pretty indicative of what I'm just talking about is what we've seen the last year, large cap dominating. Our view of large cap stocks is they're expensive, and this is based on the PE, the current price to earnings ratio relative to historical. It's gapped out, so it's pretty expensive large cap stocks. Now, that is fairly limited. It's being brought up by about a dozen names or less than a dozen names that are mega cap technology names, as you've heard a lot about this year. But you'll see small cap and international much more favorable. We're saying they're more fairly valued and attractive places to be. And then if we look down into cash and core bonds, you don't have an allocation to cash per se, but we've been willing to hold a little bit more cash in your cash accounts to fund benefits, a couple quarters worth of benefits as well as capital calls, and you're not penalized for that today where cash yields are closer to 5%. But core bonds as well, as the 10-year Treasury this morning was at 4.5%, actually bumping up a little bit over new inflation numbers that were slightly over what we saw last month. I think the September number came in at 0.4%. Expectations were about 0.3%. And that pushed yields up a little bit and stocks sold off a bit. The one thing that you don't see anything on this page is the Israeli Hamas war at this point. And the right side of this page, you see this ongoing geopolitical tensions. This is something that we can't ever predict. As a long-term investor, we have diversification across multiple asset classes to fixed income allocation of 20%, hedged equity allocation at 5%. And really these things are there to provide some protection when things go south. We don't know when that's going to happen. We can't necessarily react and take risk off the table immediately or put risk back on. So it's important that we keep this diversified approach with some insurance in the portfolio. If you look at the next slide in terms of asset allocation, we're pretty close to targets as far as the strategic targets to equity, fixed income, and real assets. We're about right on them. Fixed income, 2% underweight, but that cash is, you have a 0% target, and we're a little over 2.5% in cash, and we're getting a 5% annualized yield on cash right now. So that's really making that up. Within equities, however, we do have a little bit of dispersion from the targets, and that's primarily because we've reduced long short from a strategic standpoint from 10 to 5 and increased private equity from 10 to 15, and we're not there at the 15% in your private equity allocation. That's going to take some time. We can't just move that needle overnight, so you'll see that deviation there. And as I've talked about the last couple months, this is the actual allocation invested versus the target to that asset class. The policy benchmark, or what we measure performance against, is a little bit different than this target allocation because we're measuring private equity, that 15% allocation relative to a long-only or large cap index, 15% in the S&P 500. So you actually have quite a bit less large cap U.S. exposure in your portfolio than what your policy index is measuring on a short-term basis. That's been a headwind, as the S&P 500 is the best performing asset class. Longer term, as we've talked about, your private equity has added value, but just this year that's been a headwind. So as we look at the next page, looking at returns, year over year for that period ending September, total fund up just under 8% net of fees, whereas the policy index is up 11. And that 300 basis points is almost all private equity. If you go down and you look at the private equity line, private equity is up 5.5%, whereas the S&P 500 is up 21.6%. So that's what we're measuring that against, and so we know that there's, in the short term, a pretty significant deviation. The large cap allocation, which we'll talk a little bit more about here in a moment, we have intended to implement this large cap allocation going back many years now in primarily what I'll call a benchmark risk controlled approach. We recognize that it's difficult for large cap managers, active managers, to add significant value net of fees. So we've tried to implement this 50% in a pure passive benchmark and 50% in Intex strategy. Intex strategy, and I'll get into this a little bit more, takes very little benchmark risk, but they're taking some the way they weight their portfolio. And that has led to a little bit of underperformance in that large cap portfolio. That's not the reason why we're coming to you with a recommendation to move out of that, but I'll get into that in a moment. International equity up on a year-over-year basis about 20%. That, again, is trailing the EAFE benchmark. This gets back to you've got a little bit smaller cap allocation within your active managers, both Lazard and Harding Loevner, than what we see in the benchmark. And that dispersion in the near term, we've had several discussions with both managers. We're comfortable with what's going on there. If you look at out over the last 10 years, outperforming net of fees by about 20 basis points. Fixed income, basically a little bit ahead, although modest returns, they're still positive. That's really coming from the non-core strategies, particularly the PGIM strategy, which is what we call liquid absolute return or unconstrained fixed income. They've taken very little interest rate risk in that portfolio, and it's in a period of time over the last year where rates have gone up, bond prices have come down, they've navigated that well and been able to add quite a bit of value. And then finally, the real estate portfolio. I think we talked about this last month, and for those of you that were at the conference, I think that second to last session talking about real estate, there's good and bad, right? Looking in the rearview mirror, it's been a challenging period the last year as we've seen real estate prices re-rate, particularly in the office sector. But your manager, Morgan Stanley, the Prime Property Fund, they've done a good job of repositioning that fund. They have a pretty significant overweight to multifamily, which is continues to be a pretty compelling area, as there's not a lot of homes being built today. People needing housing, and that multifamily has continued to generate positive returns, as well as industrial. We think probably the re-rating for the most part is behind us, and you're starting to see that mitigate some. But that your overall real estate allocation, while down 6% net of fees on a one-year basis, it's outperformed the benchmark by about 5%. So with that, I'm going to turn to this other piece. we've talked about this quite a bit and feel like we need to bring it to a conclusion. So as I mentioned, your large cap allocation has been implemented in a benchmark risk-controlled way. We're trying to get the return of the benchmark and maybe a little bit of incremental return through the use of Intech. We're intending to be 50-50 allocation between the Intech strategy and the pure passive. We're a little bit deviating from that right now, and most of that has come from cash flows, as we need to raise cash where we see the most liquidity. At the end of September, Intech was about $103 million. As I've talked about before, and their strategy is a bit hard to understand. It is a mathematical, quantitative strategy, but the bottom line is it tends to overweight the smaller cap stocks in the large cap universe. And they're using the Russell 1000 index, which is a large cap index, as their fishing pond to build portfolios from. Over the last several years, where the mega cap names have significantly outperformed, that's been a bit of a headwind to their strategy. That said, they've experienced pretty significant declines in assets, not just in this strategy, but across the board. In the third quarter, there was about $4 billion in outflows in the third quarter of 2023, majority of that coming from terminations. And total AUM is now around $12.5 billion, maybe down a little bit from the time we put this together, which is down about 75% from their peak in 2018. This, coupled with some tweaks they've made to try to address some things, it's more these qualitative concerns that are bringing us to this conclusion at this point. As we look at what we're trying to do, our feeling is we've been trying to have some incremental return, but really primarily passive. Let's just go all passive is what our recommendation would be. And it'll do a couple things. Stay on this page. Down one. So what this is just why we think being passive or benchmark risk controlled in large cap makes sense. If any of you were at the conference, you saw this page a couple times probably. A lot of data on here, but what this is looking at multiple liquid asset classes that you're invested in most of these. If we look at the area that's circled, large cap core, but even if we look at large cap value or large cap growth, what this is showing is what percent of the time, gross of fees and net of fees, do active managers outperform in these various asset classes. So you'll see that the light blue is net of fees. So for large cap core managers, only 40% of the time are they outperforming the benchmark net of fees. If we look at value or growth, growth is even worse. Value's about 50% of the time. Whereas in small cap growth, 73% of the time, active managers are outperforming the benchmark net of fees. So what that's telling us is that it's much easier for active managers in small cap to outperform than it is in large cap. The next slide just shows the magnitude. And basically, this is looking at the top quartile, bottom quartile, and median manager. And you'll see for the light blue bar is the median manager. And this is really what we focus on when we're thinking about, can we add value from manager selection? Or is it likely, or is there a higher probability that we can add value from manager selection? Again, I'll look at small cap growth. You see the median manager this is excess return, is outperforming the benchmark by about 300 basis points over rolling 3-year periods. Whereas in large cap, whether it's core, value, or growth, the median manager is basically in line or slightly below the benchmark. So this is what leads us to being more passive in large cap. We have this portfolio structure that you've had, it's worked for some time. It's a little bit of benchmark risk, not a lot, but it's just our feeling there's too much noise and quantitative issues or qualitative issues going on with Intech. So our recommendation would be to terminate Intech and move all of those assets into the S&P 500. You don't need another manager. We think we can accomplish this with your existing manager and just be pure passive within large cap. It'll actually bring your fees down that you're paying. The average fee right now, because you're 50/50, Intech's fee is fairly attractive at 35 basis points, but the index fund is 1. So now your fee for large cap is going to go to 1 basis point versus an average of about 22, 23 right now.
Jason, have there been management issues within Intech, or is this just, as you said, the fish or the pond that they fish in?
A big part of it from a performance standpoint, nothing's, I don't want to say nothing's changed, because their process is purely mathematical. But they do layer in different things to this process from time to time in terms of trading and other things. From a management standpoint, there has been people that have changed, but it's not people picking stocks there. It is this process. A big part of the losing traction with assets is because performance has been hurt the last several years. And a lot of that due to mega cap outperforming across. But it's not just in large cap. We're seeing it in other asset classes as well.
Okay. Anyone else have any questions for Jason on this recommendation?
Well, not on Intech, I've got a few questions. Really appreciate, from what I do for a living, it's great to get education from you. So that's one of the things I look forward to in these meetings. One of these questions actually specifically might even help some of the others understand some of this stuff. But first question was, how do you explain, because we get into conversations with our clients about benchmark versus net of fees. Benchmarks always are higher than the net of, most of the time, are higher than net of fees. When the consumer, or in this case the board, might look at it and say, well, hey, how come you guys are not keeping up with the benchmarks? Can you help us understand in your own terms why it is that net of fees you'll never, but benchmark's always going to be higher?
Than passive?
Yes.
Right. Well, the benchmark doesn't have fees. So
yeah.
If you're investing in a passive index fund that has fees, even 1 or 2 basis points, you're never going to keep up with the index that doesn't have fees, even if you're tracking it perfectly. But if we look at this S&P 500 index fund, and this is that you're in, if you go to the page 6.
And those fees, they're not just the investment manager fees. There's a lot of other
True.
fees that go into the net performance.
Well, so I was talking about large cap, but if we look at international or emerging markets, we would say that there, the dispersion between the index and the index fund is significantly greater because of what you're talking about. The cost of custody, clearing, and trading, it's much greater in emerging markets and international. So there we're not comfortable being passive because there's no way you can even come close to the index by being passive. Within large cap, it's a very efficient market, so the trading costs are de minimis there. The size of these funds, the SSGA fund is very large, so it's very liquid, and money moving in and out. And if you look, these are net of fee returns. Just on the top chart there, the 10-year returns, what we're showing is the index, the S&P 500. We're also showing the Russell 1000, which is another large cap index. Historically, those two, the S&P 500 and the Russell 1000, track each other pretty tightly. They're pretty highly correlated, but the Russell 1000 does go a little further down in market cap than the S&P 500. So there's a little bit of difference. And then what we're showing below that is what says U.S. large cap equity. That is your composite. That is the combination of Intech and SSGA going back historically. And then we're showing the Intech strategy that you're in isolation, and then the index fund that you're in isolation. So if we look at on a 10-year basis at September of 2023, trailing 10 years, the S&P 500, the index up 11.91, the S&P 500 index fund with SSGA up 11.9. So the fees had an effect of 1 basis point over 10 years. The Intech fund up 11, your combination was 11.33. So you'll never keep up exactly, but it depends on the asset class. And I hope that answers your
it does.
question.
On that capital market assumptions graph, where was the U.S. small mid-cap asset class represented? I didn't see that. I think it was the first page of this presentation.
Capital market assumptions.
At the very first page, I had the year-to-date, month-to-date performance. under
Oh,
at
you're
the
going
bottom
back
left.
to the report, or we talk?
I think it was, yeah, right before this page.
Yeah, it's not in this, it's in the previous.
Yeah, right
The
here.
lower left.
Yeah, lower left. I didn't see where U.S. small mids were represented in the 10-year assumptions.
I don't know why we don't have it in there, but it's not in there.
It's higher than large caps, but lower than international. Would you say it falls somewhere between those two from one of your
I
previous?
think our intermediate term assumption, and when we looked at asset allocation, we would have that in there. I think their international and small cap were about the same, and we do this once a year, and so this is as of the beginning of the calendar year. I think international and small cap were about the same.
Actually, that kind of leads right into my next question. Since this was done at the beginning of the year, because of the continued outperformance we've had in the large caps, does the subsequent 10 years look more and more bleak for U.S. large caps? As longer and longer something outperforms the long-term average, the higher the chance that it's going to underperform over the next.
So I don't know if you want to take up the Intech discussion, or is this, and then I'll answer that, or that motion. I can. Okay. So our capital market assumptions, we do them once a year. We have intermediate and long-term assumptions. This is reflective of our intermediate term assumptions. From year to year, the intermediate term assumptions are going to move around much more than the long-term assumptions. Intermediate term assumptions are anchored primarily on current yield for fixed income and current valuation for equity. Not quite that simple, but that's the best way to think about it. The long term and the intermediate term for us is 10 years. So it's not next year's next 6 months. Long term is 25, 30 plus years. So those assumptions are anchored more on very long-term historical averages. So they're not going to move around much from year to year. This year, in 2023, our intermediate term capital market assumptions moved substantially, like equities across the board up about 2%, fixed income up close to 4%, because yields went from early 22 to the beginning of 23 up 400 basis points. Equity valuations, particularly large cap, were down about 25% from the prior year. So our large cap assumption went up. I think if we looked at this in 22, our large cap assumption was like under 6, like 5.9% for the next 10 years.
Yeah.
And at the beginning of this year, that intermediate term assumption was closer to 7. To your point, when we revisit this again, and we're starting that process now, and we'll publish these and we'll revisit asset allocation at the beginning of this year, our large cap assumption, intermediate term assumption, will probably come down a little bit from where it was last year. I don't think it will go down to where it was the prior year. But what that did for a fund like yours, when we came here in 2020, 21 and 22, you're sitting here looking at, in the rearview mirror, at 10-year returns that were probably close to 10%. But we were telling you the next 10 years, the expected return for this portfolio was more in the 5 3/4 to 6.25% range. So much lower than what you got over the prior 10 years, and lower than what your required return was from an actuarial standpoint. And this board has been very thoughtful in adjusting that, your return hurdle down, and not bringing it up. You know, we had some clients saying, should we, and this was a question that came up at the conference a couple weeks ago as well. Are you seeing, to your actuary, are you seeing plan sponsors or pension funds increasing their return assumption? Because our return expectations went up last year. And I think the answer was no, we haven't seen that. It's still right around 7% because it took a while for expectations to come down. We shouldn't go up just because of 1 year of valuations coming out. But long-winded answer to your question, at the beginning of next year, I expect our large cap intermediate term assumptions will be down from what they were at the beginning of this year.
I have one more about the war and, you know, its effect, but we can continue with Intech and then we can come back to that, or if you feel comfortable. Because I'm sure a lot of people are wondering, you know, what the effect of war is going to be on the markets, and should we be concerned? And, you know, I know historically, you know, we've been taught that wars have had a positive impact on the markets. In your experience, what kind of correlation have you seen, and what do you guys expect?
I think in the short term, it's very difficult to predict. I mean, our expectation is whenever a major shock event like this occurs, you see equity markets sell off, and we could also, but the challenge on the fixed income side, you normally would see yields come plummeting down as a lot of money moves into bonds. We're not seeing that just yet. The price of oil could certainly be impacted. I think as I said earlier, for long-term investors, this is why we have diversification in the portfolio, and why we stick to that plan. Long-short equity has, we're up 10% in long-short equity when long-only markets are up 20%. It's there to provide insurance in your equity portfolio, because we can't predict what'll happen. I would anticipate in the short term, could be challenging to equity markets.
Thank you.
Okay, we are going to take a step back and we are going to go to item 13B, and Chair will entertain a motion to receive the monthly investment report. Have a motion and a second. Please record your vote. Item is approved. The Secretary has informed me that we do not need to take action on item C simply because it's just a presentation. So we will move to item D, authorize termination of Intech Holdings and reallocation of proceeds among existing managers. Chair will entertain a motion on 13D. I have a motion and a second. Please record your vote. Item is approved. That takes us to item 14, comments from board, staff, and citizens. I would like to publicly acknowledge the great job, the excellent job that Regina and her staff did, and Jason and his folks at ACG did to organize and pull off a great conference down at Durant. And now we don't have to do it again for how many years? 8 years. So, but they did a great job, and any of you that were there know that. So I just wanted to publicly say thank you. Anyone else have anything for the good of the cause this morning? Hearing none, we are adjourned at 10:39. Thank you, everyone.